Hello and welcome to our channel. Today, we're going to be talking about the relationship between economic indicators and the stock market. As many of you know, the stock market can be influenced by a number of factors, including political events, company earnings reports, and more. However, one of the most important factors to consider is the state of the economy. In this video, we're going to take a closer look at some of the key economic indicators that can affect the stock market, and discuss how you can use this information to make more informed investment decisions. So, what exactly are economic indicators? Simply put, they are statistics that help us understand the health of the economy. There are a number of different economic indicators that investors use to make decisions about where to put their money. Some of the most important ones include Gross Domestic Product, GDP. This is a measure of the total value of all goods and services produced in a country. When GDP is growing, it's generally a good sign that the economy is doing well. However, if GDP is shrinking, it can be a sign that the economy is in trouble, which can cause the stock market to decline. Unemployment rate. This is a measure of the percentage of the workforce that is currently unemployed. When unemployment is low, it's generally a good sign that the economy is healthy. However, if unemployment is high, it can be a sign that the economy is struggling, which can lead to a decline in the stock market. Consumer Price Index, CPI. This is a measure of the average cost of goods and services in a country. When the CPI is high, it means that prices are rising, which can be a sign of inflation. Inflation can be a concern for investors, as it can cause the value of their investments to decrease over time. Interest rates. This is the rate at which banks can borrow money from the central bank. When interest rates are low, it can make it easier for companies to borrow money, which can stimulate economic growth. However, if interest rates are too low for too long, it can lead to inflation and other problems. Now that we've discussed some of the key economic indicators, let's talk about how they can affect the stock market. Generally speaking, when economic indicators are positive, it can lead to a rise in the stock market. Conversely, when economic indicators are negative, it can lead to a decline in the stock market. However, it's important to remember that the relationship between economic indicators and the stock market is not always straightforward. There are many other factors that can influence the stock market, including company-specific news, geopolitical events, and more. That being said, keeping an eye on economic indicators can still be an important part of your investment strategy. By understanding how the economy is doing, you can get a better sense of which industries and sectors might be poised for growth, and which might be struggling. Of course, it's always important to do your own research and consider your own investment goals and risk tolerance before making any decisions. And that's a wrap. We hope you found this video helpful in understanding the relationship between economic indicators and the stock market. If you have any questions or comments, please feel free to leave them in the comments below. And if you enjoyed this video, be sure to hit the like button and subscribe to our channel for more great content like this. Thanks for watching, and we'll see you in the next video.